What's up, guys? Welcome back to the channel. Your financial advisor is dead wrong if he is pushing you into a 60-40 portfolio. Get out of it yesterday. 60-40 portfolio made a lot of sense, made famous by Mr. Ray Dalio himself, the guy behind Bridgewater Associates, the largest and most successful hedge fund. It's like in their mission statement, everyone always introduced, this is Ray Dalio. He owns the largest and most successful hedge fund. I don't know if that's true or not, but hey, that's a heck of a mission statement. He's also the guy that brought you chicken nuggets. He figured out for McDonald's, pretty nice client to have when you're getting a company going on. And McDonald's is like, we would like to offer a chicken nugget. The problem is the cost of chicken nuggets always moving around. We can't really, we have the dollar menu and we got the numbers on the thing. If you're ordering number 7, you're ordering number 7, it's gotta be the same price. It's gotta be consistent. And so Ray Dalio looked at chickens and he said, you know what the cost of a chicken is? The cost of a chicken is the inputs. You know what the inputs of a chicken is? The feed. That means corn or grain. Grain is inconsistent because of weather patterns. It moves up and down, so therefore the price of chicken moves up and down. He figured out how to hedge grain. And so he went out and offered a financial product so that farmers and McDonald's mainly could hedge the price or the input of their chicken nuggets. And that's why you have chicken nuggets. He makes the 60-40 portfolio basically famous because it was a great idea. If you have 60% of your net worth, your portfolio, not net worth, but your stock portfolio, let's use $10,000. You got $6,000 of it in equities, maybe spread around, right? You own a little tech, you own a little like automotive in there, you own some commodities, and you own some producers, like an oil producer or something. That's a commodity, but you own 60% of your portfolio in equities, stocks. Maybe they pay dividends, maybe they don't, but you own stocks. And then the other 40%, you own debt. These are bonds. So municipalities, like your local town, they might do a bridge and they might need to raise 10 million bucks and they might pay a 6% interest rate on that. And so you would own these things. And as the interest rates go up and down, it changes the value of your bond. But if you hold the bond to maturity, you're basically gonna get 6% on the cash that you invested. If the interest rates go down to like 3%, and you're the guy that's holding a 6% coupon, which is like the bond payment that they pay every year, well, that value of the bond goes up because you're selling it at 3% now. And so, but his idea was, well, if you're in an environment where stocks are going up, bonds are probably going down. So they offset each other. And most of the time stocks go up more than bonds. But if you're in a bad environment where stocks are going down, people are running to safety, they're going to bonds. They just want to know, I'm going to get 6% a year, I'm going to get 3% a year, I'm going to get 10% a year, whatever. They just want to buy that. So it would balance, it would hedge. And he's the master himself. He's the master hedger. Here's the thing. A bond now is like a triple risk to your capital. Doug Casey's famous for saying this. He's like, dude, you got currency risk. You got inflation risk. You have default risk. It no longer works. Here's the other thing, and why I'm super bullish on gold and silver. This is why I sell gold and silver, because I genuinely think as a finance guy, if I can offer one product to my people right now, it's Xavier's pyramid. It's where if you take this pyramid, you put it upside down, at the very bottom, that 5%, that should be in gold. Like that's your base. And then above that, you got your stocks, and then you got your bonds, and then you got your real estate, or whatever it may be. I'll go into the Xavier's pyramid on a later one, but essentially gold, silver is that core base of the upside down pyramid. And actually, like in my personal life, I've got the pyramid kind of correct, like going normal, and like the bottom layer is silver, and then I'm gonna swap it into gold. So it's silver and gold, but it's like right there. And then on top of that, I got like, the real estate, and then, stocks, and then derivatives. I've got some of those things like options, things like that. So you've got a triple risk to your capital. So literally 40% of your portfolio right now is sitting there going like, triple risk to your capital. Doug Casey's advice, sell it yesterday. My advice, like personally, what I'm doing, I don't have any bonds at this point in time. Although I will say that in a liquidity crisis, people will probably jump into the 10-year treasury, the 30-year treasury, the 20-year treasury bond. So those will probably spike at some point in time. So I'm not denying that's a case. But the bigger case, and why I want to front run people before they figure this out, before large hedge funds figure this out, or large endowments figure this out. And it's not that they haven't figured it out. It's that when you're running the Harvard Endowment Fund and you're running, let's say $1 billion, and they're running way more than $1 billion. But like you're running $1 billion, you're mandated. 40% of your portfolio has got to be in this, 60% of it's got to be in this, no more than 5% in any one asset, et cetera, et cetera, et cetera. But what's going to happen when 40% of the Harvard Endowment Fund goes, oh, we got to get out of bonds? Where are we gonna go? They're gonna go to commodities, oil producers, gold miners, silver miners, gold itself, probably gold itself, because gold miners carry a lot of risk on top of it. So they're probably going to just gold itself. I want to get there early. And what will occur is as people have to figure out, what are we going to trade in moving forward? Are we going to trade in US dollars? Are we going to trade in ruble? Are we going to trade in yen? Are we going to trade, like, what are we going to trade in? It's most likely that as countries start to break down and not trust each other, they're going to look for a neutral third party. For us to trade with the Russians to trade with the Chinese to trade with the Indians trade with the Brazilians to trade with us. And it's probably going to be gold. The problem is that gold will have to grow in value to accommodate all of the monetary transactions. And so at this point in time, why everyone has a 60-40 portfolio, I am interested in collecting as much gold and silver exposure, whether that's gold miners, silver miners, gold itself, silver itself, because that stuff is out. You know, my trading account could get shut down at any point in time. My bank account can get frozen at any point in time. It's not really mine. So you have to adjust with that Xavier's pyramid, which will be another video here this week. We'll get that one out, kind of break down like the core of the pyramid, where like that very base ought to be gold and silver, because that's like real wealth that can't be printed away, that can be moved from system to system, country to country, and is outside of the hands of any third party. No third party can debase it. So we're at this spot where when 40% of all of these 60-40s realize I'm getting paid on a US Treasury bill 3.5%, and the inflation is literally 8.8%, they say. Everything I buy is up way more than that. But they say it's 8%, fine. So they're guaranteeing you that they're gonna take about 5% of your purchasing power away from you every single year. If you're running $1 billion and you've got 40% of that literally getting eroded at 5% a year, you're losing 20 million a year. Eventually your board is going to come together and be like, yo, what are you doing? Why are we getting smoked so bad? And these aren't, you know, these might be scientists, these might be doctor type of people, these might be Harvard, you know, intellectual people. And they're gonna be like, why are we getting smoked? We don't understand financial markets, but we're paying you or Bridgewater Associates or whoever to do, like, why are we getting so crushed here, dude? And you're gonna be like, well, you know, we're mandated by our rules of what we do, that 40% of our portfolio needs to be in these debt instruments, and these debt instruments pay less than the rate of inflation. And the rate of inflation is only increasing at this point in time. And they're going to go and make the logical conclusion at some point in time. Is there anything that just keeps up with inflation? Doesn't have to pass it, just maintains it until the inflation has passed, and then we can figure out what to buy. That's called gold. Is there anything that we can make at a higher rate of the inflation so we can maintain our purchasing power, but then we can also get a little extra like on top of it? That's called like exposure to gold equities, or maybe oil, you know, providers. But of course, you know, if you're managing the Harvard Endowment Fund and you're like, hey, I want to buy Exxon because it pays a 5% dividend and like they got a great balance sheet and it's selling at a low, it's a cheap PE ratio, like price to earnings is cheap. And they're going to be like, that's not green. Can't do that, bro. Find us a solar company, and you're like, a solar company that's making money, or like just a solar company. And so eventually, because everybody is always concerned about their money, eventually they're going to go, yeah, we just want to do the things that make money. And I think gold is going to be the biggest candidate for that. But if you're in a 60-40 portfolio, highly recommend getting the heck out of that ASAP. If you want to jump on the phone with me, if you want to talk about silver and gold, my number is listed below. I'd be happy to do so. And until the next video, please get down in the comments. Let me know your thoughts on this, and I'll see you on the next one. See ya.